Good morning from our global headquarters in New York. I'm Manus Crenny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Ways to go. Atlanta Fed President Raphael Bostic points to the fourth quarter for potential rate cuts, hopeful that explosive price pressures had passed. Salesforce plunges after forecasting its slowest growth ever for the current quarter. And a management shakeup. UBS appoints Karofsky and Khan as co-heads for its wealth business, paving the way for a succession race. Good morning, Manus.
A very good morning, Danny. We'll not talk about your sneakers and the potential for an IPO. We'll come back to that in a moment. Of course, it's Golden Goose. They go for an IPO.
You hate my sneakers.
I think her sneakers are wonderful. You pay to put dirt on your sneakers. Let's talk about these markets because the air sickness is palpable, isn't it, Danny? I mean, we've almost got motion sickness. The short end of the curve goes bid, and suddenly you have this thin oxygen in the ability of the equity market to actually sustain that. And I'm talking about Salesforce is down 16%, as you can see at the bottom of your screen. That's about the first ever single-digit growth outlook for the quarter. Now, this is about the outlook, and that is perhaps a little bit more challenged. It's the short end of the curve which really is holding back the equity market. Bostic says, as we said in our headlines, he's hopeful that this explosive period of price pressures has passed. But you're looking at yields at the highest since the start of May, and we've had three pretty dismal auctions. It's been the worst month for auctions since 2021. The 44 billion of 7-year paper yesterday. Bid-to-cover ratio was the lowest in a year. So we are getting incrementally more indigestion on these auctions. I put dollar yen in there. We've just seen it turn around ever so slightly again, retesting that level where we last saw intervention of 157.71. And you've got euro yen, of course, near a record low. But we know that Yellen says if you're going to intervene, it's got to be rare and well flagged. I
think motion sickness is a perfect way to describe this bond market, man, is because we're back in this world where two-sided risk is priced back in. So what does that mean? It means volatility. It's something many people who joined us, who sat in these seats, warned us about. For me, that means, what does it mean to actually be a bond investor right now? How short does your time horizon need to be? If you have a view of 2026, good luck of holding on to that and not getting really hurt in the meantime.
Just a couple of IBs that we've got, that I've got going on, which is, how is the market position going into PCE? People don't want to get long. They don't want to get long until you see one of these mother and a father day of where you see an explosion in yields to the upside. And I use that sort of, I'm caveating what the person is saying to me on IB. You need 3 or 4 hours, or you need a 20 basis point sell-off. At that point, it's either the RBA that actually raises rates, a global melt-up in yields, and that's the salivating moment when you step in and buy. That's the broker's words, not mine.
Well, I mean, we're already seeing extreme volatility.
Yeah.
And it's interesting to see what actually makes people hold on and buy in this bond market. What actually shifts the positioning to something you can hold on to long term? Again, I'm not convinced you can see that. It feels like a very short-term market, Manus.
Well, let's ask one man who's got a view on where you want to be in the markets. Cross assets. It is Mads Pedersen, CIO for Edge Investment Technology. And Mads, this is what you say. It's about the American dream. The dream is thriving despite media headlines and the Trump slogan, Make America Great Again. Employment, home prices, corporate profits are all increasing, concluding that the American dream is thriving. Now, my question to you is, it's thriving, but it is struggling on a daily basis when you see a pop in yields. What is it that underpins your fundamental optimism?
Well, my fundamental optimism is probably my happy childhood and my good life. But in this market, it's the factors I mentioned here. It's the fact that what Americans want, if we take it serious, what they have said for 100 years, is a market where everyone has an opportunity. And a lot of Americans, and a lot of this year's theme about how the change in the leadership in the market has happened. Well, it's the latest American dream example is the head of NVIDIA. And NVIDIA is making so much profits that it even makes a Chinese stimulus look small. So the American dream is doing well because the assets the Americans hold and the efforts they put in, at least in the perception you see them from the top lines, are doing well. Employment is high, house prices are going up again, equity markets have been strong. I don't know, maybe people can debate who should win the Super Bowl or which pizza is the best, but these are the macro factors Americans care about. There's the immigration problem. We leave that to the presidents, yeah?
Mads, I would absolutely dedicate a whole show to those two ideas. Who wins the Super Bowl and pizza?
Maybe not Super Bowl.
I mean, it's 5 a.m. and I would have a slice of pizza right now. So hey, we could definitely get into it, Mads. But in the meantime, you mentioned how so much is supported by NVIDIA, that contributes to the American dream. If we look at what NVIDIA did over the past 4 days, it is up 21%, but it is an S&P 500 that's down 0.75% during the same time. It used to be that NVIDIA could act as a support for the overall market. It's not happening this time, Mads. What do you make of that?
I make of it that, well, first of all, I took off 40% equities in my portfolios a month ago. So that's one thing I make of it. That's one thing I make of it with my clients and my growth portfolios. Another thing I make of it is that when we talk about bond duration, the big disappointment this year is that government bonds, which is still a very, very, very large asset class globally, they looked attractive at the beginning of the year and they've given a negative return. NVIDIA looked dangerously high and has given a fantastically good return. So I think going forward from here, will NVIDIA do very well? Probably. I wouldn't know. Will government bonds do very well? They are at least priced for doing better than they have been for 15 years. So in a portfolio context, they look extremely attractive. I haven't bought the duration yet, so we can talk about that if you like to talk about that, how much duration we hold. But we are at 3 years. But if we buy more, we're going to buy longer duration. So NVIDIA moving up tells us there's a lot of money to keep this recovery going because that is based on people actually buying their chips. Yeah, this time around, the tech boom is supported by cash and cash flow.
Can we just clarify with you? Did you say that 40% of your equity portfolio was in NVIDIA?
No, I said I had 100% equity in my growth portfolios a month ago. Now I have 60.
Okay.
I sold. So that's what I said. We reduced equities with 40 percentage points.
Okay, so that's clarity on that. Let's talk about the duration, because if we go back to the Fed pivot just before Christmas, you remember that? That was the unleashing of animal spirits across assets. So that was Powell's pivot. We peaked at around 5%. We ran all the way down to 379, and we haven't really looked back. In terms of duration, as Danny and I said at the start of the show, it's a very short-term outlook, it seems to be, that bond investors have at the moment. When you look at these pops in yield, you look at the 2 years up and kissing almost 5%. Do you want to be at the short end of the curve in terms of duration? Or are you brave enough to say, actually, as Bostic said yesterday, which is maybe the most pernicious period has passed, and it is time to think about cuts at the end of the year?
So let's talk about what I have done. That's what we do with the money. Yeah, so we bought 1 to 3 year and we bought 3 to 7 year. So that's not buying long duration. When we took off the government bonds, the next step, if the Fed makes the economy roll over or if we get a risk off, then you can buy 7 or 8 year duration. Then it becomes attractive. But for the time being, as long as the Fed's communication horizon is not 1 year, 2 years, as their official forecast horizon is, but is, as you heard, 1 quarter, 2 quarters. That means the Fed is contributing to the volatility in bond markets, and therefore bond market volatility is a different thing from bond market duration, and therefore it's very dangerous to move out until the Fed capitulates. So until they dare to put the forecast for next year as the main thing, we don't dare to buy more than 4 year duration. If they do that, if the economy starts sinking or the Fed starts cutting, then we want to have 8 year duration, so we'll buy 7 to 10 year.
Well, in terms of the long-term view, Mads, you write that you don't think the Fed will have confidence to look at an expected inflation in 2026, which you say inflation will come down by that point, but instead focus on CPI and PCE numbers coming in the rest of 2024. I got to say, you sound a lot like Mohamed El-Erian, who says that the Fed has turned into a play-by-play commentator. Is that right? Is the Fed too focused on the short term when they should be looking out 2 years from now, where, as you say, inflation will start to be coming to target?
Isn't that what Bostic just said? He said, let's talk about what happens before Christmas. So I think Mohammed and I, we stand on the same side of this. We're just observing what they're doing. I'm not going to predict it. It looks like that to me.
Yeah? Yeah, and again, it's what we're seeing is in terms of bond market volatility. Hey, Mads, I'm afraid that's all we have time for. Thank you so much for joining us. Mads Pedersen of Human Edge Investment Technology. Manis, let's get some of the other top stories trending on the terminal this morning. BHP has abandoned its $49 billion bid for Anglo, walking away from what would have been the biggest mining deal in over a decade. It also ends a 5-week public battle between the two miners who disagreed over a complex deal structure. The pressure will now be on Anglo CEO to deliver on an ambitious turnaround plan.
Canadian asset manager Brookfield is said to be close to buying 53% stake in Neoen. The offer values the French renewable energy developer at $6.6 billion. A deal would rank as one of the largest take-privates in Europe this year.
Golden Goose is seeking to raise $108 million in the Milan listing. The luxury sneaker brand plans to use the IPO proceeds to pay down debt. Golden Goose is testing the market as luxury business slows. I know you love my Golden Goose.
I love your Golden Goose sneakers, but I'll give you another brand in a moment. Coming up, we've got the hints of a heck of a race brewing up at UBS. Khan and Karofsky named as co-heads of wealth management in a strategic revamp. More on the story.
And later in the hour, we speak to Dan Gerard of State Street on why a soft landing is more unlikely than markets think. Context matters on Bloomberg. It's your Bloomberg Brief, Danny Berger and Manish Krani in New York. So UBS, Manis, it's shaking up its executive team as it prepares to complete its merger with Credit Suisse finally. Investment bank head Rob Karofsky will take joint management of wealth alongside Iqbal Khan, paving the way for a race to succeed CEO Sergio Armati. For more on this, let's bring in Alessandro Speciale, our Zurich bureau chief. Alessandro, that's been the interpretation of this, that it is a way to look at who's after Armati. Is that a fair interpretation?
Yes, absolutely. UBS has been sending 3 very clear messages. First one is that Armati is staying until the end of the current business plan, which is 2026, and a bit more after that, so let's say around 2027. The second one is that there is a preference for an internal candidate and that they want to build an internal bench. This way, as we have reported, Khan and Karofsky will be able to differentiate, play to their strengths, and show who could be the next person, the right person to succeed Armati when the time comes.
Alessandro, good morning. It's interesting. It's Armati who brought Khan into the business from Credit Suisse, and indeed he was elevated quite significantly. Do you think this is more of the hallmarks of Colin Callagher, who wants the bench to be broad in their experience? I think it's interesting that Khan is moving to Asia after quite a number of years in Bahnhofstrasse.
Yes, absolutely. And of course, it's also interesting in that respect that while Asia is crucial, UBS is very strong, and it is one of the strongest areas for UBS, Asia. But where the growth is coming from and must come from to fulfill Armati's ambition for UBS as the global wealth manager it wants to be, the growth must come from Asia. So on this one, it is Karofsky, of course, who has been elevated, and we'll see now what happens with Khan. It's an interesting setup, and of course, if someone ever thought that Khan was the heir apparent in a way to Armati, well, maybe now it's the time to think again.
Well, one comes from the trading background and the other comes from consultancy, which is, of course, Khan pushing those loans. $25 billion a year in new loans. That's called pushing the business forward. Alessandro, thank you very much. Great reporting you and the team there. Alessandro Speciale in Zurich. Over to the Middle East now. Saudi Arabia is preparing to formally launch a secondary offering of shares in Aramco as soon as this Sunday. The sale could raise over $10 billion. For more, let's get to Matthew Martin. He's in Riyadh. Matthew, why now? There's a lot of big mega projects in Saudi Arabia. The sovereign wealth fund, we know, is spending more internally. Is this pressure for capital expenditure domestically that's pushing them to IPO more of Aramco now? Good morning.
Hi, Manis. Yeah, look, as you say, the government's under a lot of pressure to find new sources of revenue to fund all of these things that it's doing around the country and internationally. The PIF is spending lots and lots of money internationally on deals and lots of money domestically. The government is looking at diversifying the economy and moving into new areas and trying to achieve the Crown Prince's plan of Vision 2030 and creating a bigger non-oil economy. And all of that is costing billions and billions of dollars, in some cases trillions of dollars for some of these big projects that are underway. So the government is it needs to find other strings to pull to be able to get money in and to be able to fund this big investment program that is underway.
But Matthew, we have seen literally days ago, Aramco shares dropped to the lowest level in over a year. Is the demand going to be there for the shares?
Yeah, look, it's going to be a tough sell to get this one done in many ways. When it did the IPO 5 years ago, then it was really the international investors really balked at the sort of price and valuation expectations around Aramco, so it had to rely on local money. This time round, it's a slightly different calculus. It's already part of the MSCI index, so we'll probably see some fund managers come in as they look to get exposure to Aramco to match the index. And otherwise, I think we'll also see the local investors who still consider this to be part of the kingdom's crown jewels. Overlaid across all of that, of course, is that you're going to have a lot of investor concerns around ESG, the future of oil. So this is all potentially going to weigh on demand. But what we've heard from sources already is that informally, Aramco's already got around $10 billion of interest from investors. So it looks like it shouldn't have too much trouble placing this. The big question is going to be, where does it go? Who are these investors? Is it from the region? Is it internationally? And how big a commitment does each one of these investors want to place on this stock?
Okay, Matthew, thank you very much. That is Bloomberg's Matthew Martin. Manis, let's get a quick check on the Rand. You brought this up this morning. Yeah,
I mean, it looks as if the ANC are going to potentially lose control, and this is going to be a split parliament. That is the thinking at the moment, and this is, as you can see, the dollar ramping in the first instance and just turning around. It's going to be the ANC losing its dominance in the parliament for the first time since apartheid fell some 30 years ago.
And the risk is that they need to form a coalition government. So who do they do it with? They could do it with the market-friendly Democratic Alliance, or there are two other populist parties who want nationalization of the mines and the banks. And that's the fear you're seeing in the Rand. Do we get a coalition government that is less market-friendly?
Yeah, we're talking about Democratic Alliance with 26%, 26.3%. These are the early indications. The Economic Freedom Fighters with 8%. But then, of course, Jacob Zuma's, he's coming back with his MKP party at 7.6%. So there's a lot of nerves jangling in South Africa. We're going to talk about Danny's sneakers. And other people have got them as well. Golden Goose. They're planning to raise over 100 million in a Milan IPO. The CEO, Silvio Campara, joins Danny and I next on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger alongside Manis Cranny in New York. We got to talk about shoes, Manis. Indeed. A pair of shoes that Manis likes to make fun of me for. They are Italian luxury sneaker brand Golden Goose. You know them. They look distressed and they are pricey. Well, they're planning to raise an $108 billion IPO in Milan. Let's get the details. Joining us now, I'm pleased to say, is CEO Silvio Campara. Silvio, thank you so much for joining us. So why IPO now? And what have the bankers given you for the best estimate of valuation you can get?
Thank you so much, first of all, for being here. And thank you so much for taking me here into this moment, because it has been a long journey, 24 years of emotions, passions, dedication, and of course, it's just the beginning. And why an IPO? It is such a beautiful story that we wanted to share this story with many people. And the ambition here is great, and we want to make sure that we're going to have next to us the best investors and the best people possible to deliver all our ambitions. That's why we think IPO is going to be the best place to be right now.
Silvio, good morning. The question that Danny and I have, we want this to get some context. The most successful IPOs, the appetite for IPOs that we've covered have been technology companies, not necessarily fashion companies. Why is it that you think now is the time to bring a fashion brand to the IPO market? What's going to stand out versus the tech IPOs that are out there?
First of all, I will answer saying that every investors, now that I had quite an experience after these months of journey with investors, they love beautiful stories, first of all, and unique stories. This is the first answer I will tell you. Then fashion. Golden Goose is not fashion. We are an experiential company. Most of the people is familiar with the sneakers only, but the Golden Goose customers knows very well that when they join Golden Goose places, they're not joining just because of the shoe, but they join because of the experience. Because Golden Goose is the only place in luxury where you can co-create. You can personalize
Silvio, if I can jump in here,
product.
because you have this beautiful story that you talk about, that you want consumers, you want the investors to know about. So what kind of valuation do you think you can get for that beautiful story?
I think the valuation will be decided by the market, okay? And I think is part of this next part of the process. But for sure, I think every valuation will come out will be the best valuation for our investors.
I mean, this is where we will press you a little bit. The coverage is around 100 million. Is that a reasonable ambition for you to raise from this IPO? Let's square that away, and then we can talk about the beautiful dream.
Of course, I think it's a reasonable one. Absolutely. And I think, in all senses, the company has been delivering a great growth, very healthy one, delivering amazing EBITDA, amazing EBIT, amazing cash conversion. So honestly, I think there's only blue sky for us, I'll say there.
Silvio, what you're saying, I have to say, it's quite different from what we've heard from some other luxury companies. You look at the aspirational wealth. Basically, unless you're Hermes, in this market, folks are struggling because you have a middle class who isn't as willing to pay up anymore. Have you seen any signs of slowdown in demand, given where we are in this economy?
Thanks God, so far, no. And I have to say that there are three main reasons. First of all, the category, because sneakers, it has been so far the gate to luxury for all the new generations. It's important to remind to all the people watching the video right now that 85% of our consumers is between 16 to 45 years old. And going to the price that you were mentioning, then it becomes very important. And that's why we proudly remind every time that we are the only luxury company that never increased prices like all the other luxury brands, while we've been simply increasing prices at an inflation rate along the last decades. So all these, together with the experiential part, is making really Golden Goose one of a kind in the sector.
Well, you've already got one fully branded customer on this show, and I'm kind of sold on the idea, Silvio. Now, I'm in the market for some new luxury sneakers.
We'll get the shiny Swarovski ones, Silvio.
I want the Swarovski ones. Look, where are you seeing? On a slightly more serious note, we're here in the United States. You're in Italy. You're at the heart of Europe. Where is your strongest market with the strongest capacity to price?
But first of all, there's no just a market notion in Golden Goose. Again, we are not design focused. We are always proud to say that we are consumer obsessed. So no matter where you stay, no matter who you are, we think that there's so many people that is willing to have an enjoyable moment, a moment where they can experience their own creativity, and of course,
but can I press you, Silvio, in terms of? I mean, we're on short time here. We need to know where in the world is your strongest market? Is it in the United States? Is it in Europe? Where is the strength of demand?
Of course, it's United States and Europe, and of course, the white space is everywhere in every geography because we are already in more than 82 countries out there.
Silvio, we can joke as much as we want about blinged out sneakers. I know we talked about in the break, but I actually do want to go there because I'm looking on your website and seeing a pair. Is this right, for over $2,000 for Swarovski embedded sneakers? Again, we are in a moment or time where folks are starting to feel the pricing pressure. They're not willing to pay up as much. Do you see yourself continuing to go into that side of the spectrum of the ultra luxury consumer? Is that where your business needs to be? Or is it on the lower end, something like $400, which for a lot of people isn't the lower end? But which side of Golden Goose do you want to concentrate your business on?
When you do our business, it's about acquisition and retention. So you need to make sure to have a batch of product that is perfect to acquisition, so the 435 euro. And then, of course, it's a journey. I have more than 3,000 sneakers. So there's a part of your journey where you feel to buy, a shoe of $2,000, and there are days, and part of your journey, especially when you enter, where you want to enter with a reasonable price. So that's why it's important for Golden Goose to offer the entire price range and to protect and develop all the price ranges.
I'm certainly sold on the concept. I might not be with the crystals one. We'll leave the glamorous side on this show to Danny. What the market will want to know, and we've talked a lot to private equity on this show and to various people who've been invested in by private equity. To what extent would you say that there was a pressure to exit from Permira, your private equity holder? Was there a pressure to return cash, and is that the reason why you're choosing IPO now?
Absolutely not. And the answer to that is their job, of course, is to sustain the growth of a company. We've been doubling the business together with Permira. We've been doubling the number of stores together with Permira. And we also verticalize our business together with Permira. And on top of that, the other great news is that the entire management, including myself, is going to stay, is going to reinvest. So all investors will be very happy to know that everyone that has been making and contributing to this incredible story will be still here tomorrow.
Silvio, thank you so much. We wish you well. We hope you get the valuation that you're looking for and that you go on to double the sales and double the growth and continue that beautiful dream. Thank you for joining Bloomberg First. That is Silvio Campara, the CEO of Golden Goose. We're going to see what these markets are doing. I mean, how many pairs of these have you got, by the way? Just
not as many as Silvio. He said he has 3,000 pairs. Who has room for 3,000 pairs of? I've got one. I've got one of these things, Manis, just to put it in context.
I mean, I'm worried that you're going to go out and buy the Swarovski ones next. I mean, no, you're in the market. You're mid-tier market.
But I think it's Silvio saying, like, some days you feel like going out and buying a $2,000 pair of sneaker. I feel like buying it, but will I do it? Probably not. But hey, he says demand's there. People are still buying to him. The consumer is strong and healthy and buying blinged out shoes.
And he's in over 80 countries. Okay, so that's a beautiful dream.
Yeah, well, that IPO coming to the market soon. In the meantime, let's get a check on this bond market. Yields are lower by about 2 basis points, so some relief from what we've had over the past couple of days. They took another hit after a weak U.S. auction yesterday and inflation pressures in Europe. Meanwhile, equities down this morning. Have stocks finally woken up to higher for longer? The S&P had been on a track of 23 out of the last 30 weeks advancing. That's a joint record going back to 1989, but we're on track to fall for a consecutive day. Is it because of Salesforce? NASDAQ also down 0.4%. Salesforce at one point was down 16%. We're just less than that at this moment, saying that the current quarter will stall to be its slowest in its history, Manis. So we're at this moment where, again, equity markets, have they finally woken up to this idea that we are higher for longer? Or is this just a reprieve? Is this just a stop and a think of maybe we need to reprice, but growth is strong enough to keep chugging higher?
I would say we've got a touch of oxygen sickness or motion sickness. Every time we see this sort of slight convulsing, more so at the short end of the curve, we see this moment of where the equity market finds it a challenge to continue higher. And there's no doubt about it, those bond yields back at the highest since May provoked a reaction function. And NVIDIA doesn't have the same alpha that it had pre-results as post-results. What is it, 4 days, its ability to add nearly
20%.
20%.
Huge.
And yet SPOs were down nearly 1% on the back of that.
Yes, exactly.
When you extract NVIDIA.
Yes. Why isn't the equity market playing along at the same time? Maybe this equity market is still pricing in sunnier skies. State Street's Dan Gerard writing this: the market continues to believe in the soft landing story, but the end of this current cycle is very unlikely to develop this way. Dan joins us now. Good morning, Dan. Thanks for joining us in the studio. Okay, so if a soft landing is unlikely, what is likely in your mind?
Look, I think we return to this historical version of markets where we have more of a tension for the supply and demand of credit. And that comes when the Fed is their own credit comes out of the system. And we have this kind of, let's call it pseudo QE that continues to happen with the unwind of the reverse repo facility that's continuing to fund these markets. It's continuing to allow the flow of credit. Just there's so much liquidity. But we're already seeing a decline in the growth rate of credit expansion. And that's really important because it's not just about tension for where credit's going. It's falling in both the financial markets and in the real economy. And that's what brings about, I think, this slower growth period for both.
So it sounds as if we're in the foothills of the beginning, you know, we're at the start. We're at the start of the cycle of really where constriction begins to kick in. And so the question we would have then across assets, you look at spreads, high yield, you look at investment grade, tight as they can be, equity markets record after record, and of course this momentum, this really, really strong pro-risk momentum. Does that begin to fade in these next 6 months as we go towards an election, as we go towards the end of this QE and pseudo QE? Do things begin to tighten up, spreads widen, equities run out of oxygen?
Yes, I think that's exactly right. And part of it is because it becomes a little bit harder for the Fed to go into a cutting cycle before an election, as we know. It's not impossible, but it would probably take a little more softness. But as well, you're right. I think that we start to see the hit of more of the reaction of markets or the lack of supply of credit that begins to hit these markets. And if you want stocks to outperform their earnings, you need it to be financed with growing credit. And you either need earnings growth.
Lag arrives.
Well, I was going to say, one of the arguments, Dan, as to why that lag isn't arriving is that everyone refinanced at rock bottom interest rates. What do you say to that?
Again, that's right. And it's actually putting, as we've seen, supply pressure on the mortgage market, on the MBS market. It's harder for banks to take on MBS on the asset side of their balance sheet, or just call it mortgages. But, you know, what's interesting is that the the stabilization in credit right now is actually coming from a little bit of a surge in the mortgage market, not, you know, from a low base. But that's an important factor as well, because it's a conundrum for the Fed. If the Fed starts to ease up and what they're getting is actually more mortgage supply, higher mortgage prices, then, you know, that's what, 2/3 of core services, 1/3 of the overall inflation input. That's the wrong way to go.
I think it is. A lot of people have come on the show and come with Danny and I and said, look, we're getting used to a new normal. And we've said this a couple of times this week. A new normal in terms of rates, a new normal in terms of tariffs, a new normal in terms of volatility. But one thing which is identifiable this week, we've had 3 tepid auctions. Let's just use that word, okay? Let's not make it any more than that. But we're on course for the worst bid to cover ratio since 2021. I just wonder if we're near the beginning of the long variable lag arriving in the macro policy. Are we at the beginning of a moment of reflection in the bond market of really where deficits will matter and indigestion can mount? And I put it to you, indigestion can mount in this bond market because of deficits and the election risk.
That's right. And again, I think that if we think about this in terms of the shortest part of the curve in policy rates, but what happens to the long end, especially when we have so much supply, poor auctions, and a lack of willingness for banks to add treasuries to their balance sheets, because, you know, we've seen what happens if you have too much and you're worried about the actual long end rising and a steepening of the curve in this environment. So again, there's not a lot of great reasons or potential for banks to expand the asset side of their balance sheets here with either loans or securities, and that's credit starvation in the end.
And that's also your view that we haven't yet seen the bottom in the financial sector.
Right.
What does the bottom look like?
Well, I think that it's not crisis like we've seen in the GFC period, in the financial crisis, just because just capital ratios are much better. But it's stress, and it's stress coming from a few different areas. Banks are raising loan loss provisions. They're not provisioned for recession right now. We're starting to see some of the assets show signs of stress. We're seeing delinquencies rise back to or even a little bit above pre-COVID levels. Charge-offs are starting to rise in the C&I space. So it's a period where these valuations, these expected valuations for banks are only attractive if you get double-digit earnings growth for the next 2 years. And is that likely? Is it likely if you have net interest income that's not going to achieve what you want it to achieve?
Listen, one thing that Danny and I didn't touch on through the morning, we got interrupted by a CEO, which is always great. OZK, one of the regional banks, Danny saw this on the way in, down 17% yesterday. Now, that was downgraded by Citi. This is in Little Rock, Arkansas. But then you look at the broader bank exposure to REITs. This is a New York university, some of the profs at NYU. The property blind spot is the US. It's in commercial property, $345 billion of indirect exposure to REITs. Now, look, you can say it's still not a huge percentage, but there are a number of big funds that have, shuttered or reduced the exit, Starwood and Blackstone, to name but two. Will this story come back up the rankings in terms of a concern on the commercial property front?
Right. We always talk about the smaller banks as having commercial real estate, non-farm, non-res is the largest part of the asset, or the largest single item on their balance sheet. But you're absolutely right that indirect exposure through REITs on the large cap side is important, and it is. I don't know if it's mispriced per se, but it is underappreciated for sure. And the banks that have the most exposure to commercial real estate are actually the least provisioned, it seems like. And it's certainly a sign that we'll see more unexpected stress, I think, in the next couple of quarters.
Well, certainly that story talks about credit lines, that's where the risk is. It's the off-balance sheet risk rather than the on-balance sheet risk. Dan, thank you so much for joining us, especially coming into the studio there. Dan Gerard of State Street. Context Matters on Bloomberg. It's Bloomberg Brief. I'm Manus Cranny alongside Danny Berger in New York. So Salesforce had its biggest slump since 2008. As you can see, the stock is down now 16%. The forecast is for the slowest growth in the company's history for the current quarter. Let's bring in Alex Webb for a little bit more. I mean, this market is convulsing on this. Is the company struggling to stay relevant? What is their AI proposition to the world? And is that the headwind that they're facing from competition?
Yeah, this very much seems to be the issue right now. We saw it last week with Workday, a company that's in a very similar space to Salesforce in terms of enterprise software. You still have companies spending money on enterprise software. It just looks like a lot more of that spending is going to artificial intelligence than to the likes of Salesforce. And you have a slight double whammy here because you had some analysts certainly highlighting the huge potential that Salesforce has in artificial intelligence, that it is working on things that could yield results. Those results are not yet coming through, and people still expect them to come, but maybe not till 2025, 2026. In the near term, doesn't look so great. You're pivoting as well at Salesforce away from a sort of high growth model, more towards a bit more value, trying to, they've been increasing dividends and those sort of things. Put all that together and you end up with the lowest growth in sort of 20 years at Salesforce, and therefore a share price reaction which is pretty commensurate.
Well, yesterday was a tale of two tech. Salesforce down, HP higher, the hardware doing well, the PC cycle maybe finally picking up. How does that set us up for Dell after the bell today, Alex?
Yeah, I think expectations around Dell have really accelerated in recent weeks. We saw that big announcement where they teamed up with NVIDIA at the big NVIDIA conference a few weeks ago, and there is now, as you suggest, a great amount of expectation around a hardware upgrade cycle that we've seen sort of slowing PC sales and, of course, slowing smartphone sales in recent years. As more and more artificial intelligence capabilities are built into the software, you do also increasingly need improved hardware. This isn't all going to be done in the cloud. Some of it is going to be done at the edge. And when people talk about the edge, they mean on laptops, on devices. The question really is, are expectations already too high? Can they meet those expectations? That's going to be the rub when it comes to the numbers later today.
Okay, Alex, thank you very much. That is Bloomberg's Alex Webb. Okay, along with the tech earnings, we also have some retail earnings. Best Buy, Nordstrom, and Gap are among the retailers reporting today. Now, we have had some economic data recently that suggests that maybe shoppers are pulling back, but of course, the consumer confidence of earlier this week was strong. So where in the world does that leave us with the consumer? Joining us now is Andrea Felstead, Bloomberg Opinion consumer columnist. Andrea, again, it is a confusing time. Some numbers show strength. Some companies say weakness. Some say trading down. Manus and I were just talking to the Golden Goose CEO who said, yes, people are willing to spend $2,000 on sneakers. So today, what do we want to know about the consumer? What are we likely to learn?
Well, I think there is absolutely no doubt that some US consumers are under pressure. Lower income consumers and also middle income who are impacted by inflation, everything going up. The top end consumer is still spending. Now, you've got those lower end middle earners who are under pressure. What that means is they are being discerning about what they spend on. For a retailer, if your products are good, if your prices are good, as we saw with Walmart, that's attracting lots of people trading down. Where consumers don't feel that they're getting good enough products, or they don't feel like they're getting value for money, as we've seen with Starbucks, some of the fast food chains, they are not spending. So yes, there is a consumer issue, but also it's down to retailers to come up with the best products and at prices that consumers don't mind spending their money on.
Yeah, I mean, we just, as Danny said, we just finished that conversation with the sneaker CEO, Golden Goose, and as he said, he has not been raising prices aggressively as some of the other higher-end fashion brands have. You talk about a bifurcation in the market. We're going to get a little bit more of a snapshot of what that sort of working end of the market is doing in Gap. It's a turnaround story. I mean, ironically, I was in Banana Republic the other day, and they've launched an amazing new homeware, an entire revamp on one of their stores. I was actually really, really shocked when I walked in there. But in terms of Gap, what do we think we're going to get?
Gap is in a turnaround phase, but I think it's still fairly early. I think we might not see the full impact of that yet. Now, Gap has really, come to the fore over the last month. It's back in the cultural conversation again. Their new designer, Zach Posen, dressed Divine Joy Randolph at the Met Gala in an amazing dress. Anne Hathaway wore a Gap dress a couple of weeks ago. It's had some really interesting collaborations. We are back talking about Gap in the way we haven't for years. What we have to see is that translating into sales. It's great having, a real showstopper on the red carpet. What you need is your customers to come into stores and be equally delighted about what they find there. And I'm not sure we're at that phase yet.
It's very reminiscent of that sort of whole Henne's collaboration with various models and collections. So if the old ones work, pull them out of the bag, I say. Andrea, thank you very much. Andrea Felstead of Bloomberg Opinion. We'll see what the Gap numbers are in just a short while. Check in on these markets, Danny. Yesterday we struggled with higher yields. Equities down by 0.4%. To what extent is that being dragged lower on the sentiment from Salesforce? Certainly the glory of NVIDIA seems to be fading. Nearly 500 billion in equity market value added over 4 days. But of course, we've been looking at that correlation coefficient. It seems to be fading relative to the rest of the markets.
Right, AI was supposed to be the thing that saved us. And we've talked to how many people that said stocks can do well if yields are higher because growth is good. But Manus, is this just a short-term repricing? Because can you have higher rates and good growth, or you need to have lower rates and soggy growth? You can't have the best of two worlds, and maybe that's what this market is coming to terms with.
Yeah, we just finished that conversation with State Street, where we are at the beginning of the long variable rag arriving, and you're not going to have any QE or pseudo QE to help you.
All right, coming up, U.S. GDP numbers, plus more Fed speak on the docket. We'll tell you what you need to know for the week ahead. We've just been looking at some very expensive shoes.
Very expensive.
It's Danny Danny Berger and Manus Cranny in New York, dreaming to a life of luxurious shoes. Okay, let's get you set up for the weekend, for the day ahead. Numbers are going to come out for U.S. GDP at 8:30 a.m. Eastern, along with another round of jobless claims. Then we're going to get Fed speak from John Williams and Lori Logan throughout the day, and we'll have some more retail earnings. Nordstrom, Costco, and Best Buy, all after the bell, Manus.
My good movers for you. Birkenstock, we're in the shoe fest on this show today. Birkenstock lifts its annual profit target amid strong demand for sandals. Well, they're a bit more than sandals, aren't they? Raising the revenue estimate, anticipating growth of as much as 20% at constant currency. Moderna, on the pharma side, gains. Financial Times reports the U.S. government is nearing an agreement to fund its late-stage trial of a pandemic bird flu vaccine. And then Palantir gains as the U.S. Army awards a $480 million contract for a project called Maven Smart System through 2029. And that deal adds to the firm's growing suite of AI offerings. So we've been talking to the Golden Goose CEO. He's not raising prices, but you can still get Swarovski crystal sneakers at $2,000. The only question on Bloomberg Brief is, would you pay $2,000 for Swarovski crystal sneakers? And tell the truth.
No, I wouldn't. I would, though, bling it out myself, maybe get crafty, maybe save some money. But I think it's sacrilege to buy a $500 pair of shoes and then put crystals on them. But that's what you're paying for. And Manus, as we're confused about the consumer, I think we need to add this other layer in that people are paying for stuff like that and paying for Manolo Blahnik Birkenstocks that cost over $1,000. Go figure.
Look, it depends where the price point is for resistance. Christian Dior Birkenstocks are $800 or $1,000. The Golden Goose sneakers are anything up to $2,000. But that CEO hopes to raise over $100 million, and his strongest markets are here and at home in Europe.
And in Europe. Interesting he didn't say China, for what it's worth.
Yep.
Okay, that's it for the brief. Surveillance, that's up ahead.